From December into January, inflation back on the rise in the U.S. And so even though there have been some signs of easing prices in parts of the economy, this was another reminder that for the U.S. Federal Reserve, which unlike the Bank of Canada is not yet in pause mode on rates, Jay Powell and the Fed officials are likely going to continue on with higher interest rates, and investors trying to figure out what exactly that means for the economy, especially if, for example, the labor market stays tight. Let's get some more insight on all of this now. Jay Bryson is chief economist in the corporate and investing banking division of Wells Fargo, and he joins us with his reactions. Jay, it's always nice to have you join us. What did you make of this inflation print today?
Well, in a word, it wasn't real good. I mean, it came in on consensus in terms of the monthly increase. We knew that the inflation was going to, on a month-on-month basis, was going to pick up just because gasoline prices rose about 10% back in January. But even when you get rid of gasoline, you look at kind of the core part of the economy, that still rose 0.4%. And so, if year on year, we still have a core inflation rate of close to 6%. It's just not where the Fed wants it to be right now. And
yet the question about what complicates the story for the Fed continues to additionally be the tight labor market and the idea that you might see some wage pressure. What's interesting to me, Jay, is you've got a lot of people debating what kind of economy we're staring at right now and what were some of the effects that essentially came to pass because of the pandemic. And maybe we have to look at this economy a little bit differently, as opposed to sort of saying, well, look, these are all clear signs that inflation is just going to stay elevated for a long period of time.
So what's interesting when you dig a little bit into the deeper here, what we've seen over the last number of months is prices of goods, excluding food and energy, we call these core goods, the inflation there has come way down. And this is, you talk about the pandemic, this is now we're on the flip side of that. Supply chains are working again now, and so prices are actually starting to come down there. It's the service sector where we haven't seen any signs of disinflation yet. And it gets back to, you're talking about wages again, and during the pandemic, the service sector got hammered. Then there was a big pent-up demand for that. People went flooding into the service sector to buy, to go on trips, to go to restaurants, et cetera, et cetera. Big increase demand for there, and that's where we're still seeing the inflation pressures. And frankly, that's where you have to see the labor market cool off, because for most service providers, wages are the biggest cost component.
Now, the market itself is down today, the stock market, I mean, but arguably there were points during this cycle where you would get discouraging inflation readings and investors would really hit the sell button. What do you think the current state of affairs is when it comes to where the economy lands through all of this? And does that factor into the sentiment among investors, in your opinion, right now?
Well, so our forecast is, and actually it has been for quite some time now, we do think the U.S. economy is going to experience somewhat of a modest sort of recession this year. And if that's true, then, I wouldn't think that's a great environment for, for many companies. If their sales start to weaken, in that sort of environment, that's still kind of our base case. And then if you have lingering signs of inflation on top of that, and the Fed seems like it's going to be on hold for a long, long time to wring the inflation out of the economy, you could be looking at a recession that maybe it's not all that deep, but could be kind of prolonged, number of quarters. And so, I think that's what we're looking at right now. At least that's our base case sort of scenario.
And through all of that, obviously looking ahead to that possibility, the idea of just chugging along with potentially more interest rate hikes by the Fed, and I want to clarify the difference with our Bank of Canada right now, at least in pause mode. We'll see if that changes. But the Fed just carrying on with interest rate moves from here?
Yeah, I mean, the way I would think about it would be they're near the end of their cycle. They're in the kind of the fine-tuning stages right now. Before they were going 75 basis points at a clip. I'd be very surprised if you see that now. But, you could see a number of 25 basis point increases over the next few months here as they try to fine-tune their way into what they still hope will be a soft landing.